Hey, good day to you. Welcome back to Dapper Dividends. It's good to see you. Thanks for swinging on by for just a little bit and investing some of your time with me. If I provide you anything of value at any point during this, please don't hesitate to give a naval veteran a like and a subscribe. I really would appreciate that. What my channel is focused on is primarily just passive income, whether that's through stocks or through staking my cryptocurrency are kind of the two things that I like to focus on and talk about, and a little bit of personal finance smattered throughout as well for good measure. So this video comes with a little bit of sadness attached to it, as the impetus for it was when I was reading yesterday about the death of Thomas Farrell, who was the CEO of Dominion Energy and passed away one day after retiring from the company as chairman, president, and CEO at 66 years old, and had been battling cancer, which took a turn for the worse. He had been CEO since 2006, and he also had served as Altria's chairman since 2008. I really wasn't that familiar with Dominion. I've been hearing about them through the dividend investing community grapevine, and all I knew about them is they were a utility company and they had recently cut their dividend. So figure this would be a good time to take a little bit of a dive into Dominion Energy and see if they are a company that I would be comfortable investing in. Dominion Energy produces and distributes energy through four segments: Dominion Energy Virginia, gas distribution, Dominion Energy South Carolina, and contracted assets. They service 7 million customers throughout 16 states and changed their name from Dominion Resources in May of 2017. They were incorporated in 1983 and are headquartered in Richmond, Virginia. Now, Dominion Energy is a low-risk regulated gas and electricity supplier. And if you're not familiar with what regulated means, all that it means is that they have complete control from generation to meter, and their prices are indeed regulated by public utility boards or by government that shields them from competition and ensures that they will constantly have a steady stream of customers. They have been transitioning into a more regulated company as they expect approximately 95% of earnings from their primary operating segments to come from regulated and long-term contracted businesses, as we see there in that 2018 annual report. So at this time, we're going to pop on over and use simply Wall Street to dig through some of the numbers and get a little bit of a better snapshot at Dominion Energy. As of this recording, they were trading at $75.72. Their 5-year return with dividends reinvested was only 28%, which was really lagging the industry at 52.5%. Price to earnings ratio is not really that good at 44.6 times earnings, with the industry average at 22.1, so they're double the industry. And what that means is you're paying $44.60 for every $1 of Dominion's earnings. Over the past 5 years, they have had a negative 7.2% growth rate. The long-term financial health looks good, but that short-term quick ratio is not very good. They are not a liquid company right now. I'm a big proponent of the ICR ratio as looking at a debt metric. This is able to tell us if they're generating enough operating income to cover the interest expense. Think of it as if you're earning enough money to pay the interest on your credit card. Same thing for the corporation. So Dominion is currently at 3.09, which is not very good. I really like to look for a minimum threshold of 5. So that gives a little bit of wiggle room for interest rates to spike and increase, and a bump in the road for operating income to take a bit of a hit. As of this recording, Dominion Energy has only $3.09 of operating income to cover every $1 of interest expense, which is a big red flag in my book. The dividend yield is at 3.33%, which is in line with the industry average. Now you can see they had been increasing their payments up until November of 2020. They had been increasing the dividend there for a pretty nice clip until they cut the dividend in November of 2020 to $2.52 or 63 cents a share per quarter. The current earnings per share payout is 203% according to Simply Wall Street. Now this is on earnings per share, and I'm not a big believer in using the earnings per share number because that is an accounting number which is susceptible to accounting manipulation. So a much more reliable metric is the free cash flow. So the free cash flow on Yahoo Finance for the trailing 12 months is at $793 million, but they paid out $2.87 billion in dividends, which is an overage of 362% roughly. That's no good. That is a problem, and that is a massive red flag for me that has me very worried, because as a regulated public utility, they should not be that affected by COVID and what we saw most companies go through in the wake of the 2020 market crash and the pandemic. It's always nice to see when people inside the company are buying shares of their own company, because it means they believe in the company's direction. And they have had 16.4 million shares bought over the past 3 months. And along with those lines, you want insiders buying and you want high institutional ownership, of which they do have at 66% institutional ownership, followed up by 33% of the general public. So that's where they are, where they've been, but where are they going? We need to be looking through the windshield as investors. Analysts predict 17.9% annual earnings growth, which according to analysts is going to beat the industry at 10.8%. Simply Wall Street valuation, they use a discounted cash flow model. What they do is they look basically 10 years into the future and try to discount that back to a price today, which is no bueno, showing that Dominion Energy is about 54.7% overvalued. They give them a fair value of $48.94. So there you have it, Dominion Energy, just a few too many red flags for me. I would much rather invest in a company like Duke Energy or Consolidated Edison, which, full disclosure, I do invest into those two utility companies. If you're holding Dominion Energy, I would say to just keep on holding, especially if you're above your average. But for somebody like me who is not an investor in Dominion, there's just not enough there to make me want to initiate a position anytime soon. So it's no bueno for me. I will not be investing in Dominion Energy. Follow me on Twitter at RustyRam78. Check me out on Instagram at Dapper Dividends. And if you've been helped at all, again, like and subscribe and all that good stuff. But most importantly, leave a comment, please. We want to hear from you out there in the community, because expertise comes from you. Yes, you out there in the community. Leave a comment in the comment section below, because you know where the comments go. We would love to talk to you, and I will talk to you in the next video.